a Black Monday for Asia markets.
I saw was actually people carrying cardboard boxes out of the office.
Oh, wow.
So I'm at a point now where I stopped checking. I just try not to think about it.
So back to what I was saying. Could be us.
Hi everyone, welcome to the Beansprout Podcast. My name is Gerald, I'm the founder of Beansprout, and together with me today I've got Julian as well as Nicole.
So I think it'll be interesting for our listeners to know that actually we put this podcast together in maybe just slightly under a week.
Yeah.
When Gerald first floated the idea, I think it was something that really resonated with us. I think for us at Beansprout, what we've always tried to do is that while we are creating content online, I think a big part of what makes us unique is that we are really looking at this as a journey that we are taking with our listeners, right? We ourselves are also constantly learning about new financial products, asset classes, and things like that. We ourselves are investors, right? And we're going to talk a little bit about what we ourselves have been experiencing, and hopefully that is something that our listeners can relate to and kind of feel like they're not alone, right? And they're not just regardless of how they're feeling, it's not just them who's feeling it, but we ourselves are also navigating some of these things.
Yeah, and then hopefully with that, because there might be a lot of noise out there when it comes to the financial markets and it comes to financial news, hopefully what we want to try to do is to help you cut through that noise and give very clear, actionable insights that you can practically apply in your life, coming from people who are also in a similar situation.
And I think more importantly for Beansprout, we have always believed that it is not just about what to buy, when to buy, but more importantly how that aligns with our individual financial objectives as well as overall financial planning. So hopefully through some of these stories, we'll be able to make everyone think more about why they are investing and what they hope to get out of their financial journeys.
Yeah. With that said, Nicole, would you like to maybe just give us a quick recap of what's been happening this week?
Okay, so I'm sure as many of our listeners and everyone here have experienced, we had I think a week where it felt like a month. The reason we started this podcast in the first place is because of Trump's recent announcement of the kind of blanket tariffs on a bunch of countries, and he announced it on April 2nd, which he termed that day as Liberation Day, a day to liberate America. And after the announcement, I think the fallout from that particular announcement was quite vast, I guess. A lot of people online in the news started talking about, what these tariffs are, what they mean, how is it calculated, why certain countries get slapped with 90-something% tariffs and then other countries only 10%. So there were a lot of discussion around that. And then it seemed like, I think people were not sure whether that was true, whether he was going to go ahead with it or not. So I think initially the US market did tumble on the day that it was announced. It went into bear market territory, so it dropped almost 20% from its recent high. And after that, we see some reactions from other countries, most notably on April 5th, China retaliated with a 34% tariff on the US. So, and Trump didn't seem like he was backing down from this whole tariff thing and the implementation of it. So markets continued to react badly to the news. And we saw that on Monday, April 7th, it was almost like a Black Monday for Asia markets. Asia markets dropped, and I think the STI went down about 7.5%, closed 7.5% that day. And people were very worried. There's a lot of doomsday scenarios. And then a couple days go by, and then on April 9th, I wake up one morning and I hear that was supposed to be the day that tariffs go into effect. Tariffs did go into effect, and then a couple hours later, Trump announced a 90-day pause for most of the countries, except for China, which would have a tariff of up to 125%. And lo and behold, what happened is all the markets reacted. So markets rallied. The S&P 500 had its biggest one-day gain since 2008, and the STI closed up 5.4% on Thursday.
Right.
So that's just a rundown of the past
Yeah.
7 days. Things might change from the point that we filmed this to the point that it's being posted, but this is the rundown of what we've experienced so far.
Right. And it's
Yeah.
almost as though I feel like, I'm watching my life as a movie. I don't know what's real and what isn't. And the fluctuations have just been, it's nothing that I've seen, at least in my lifetime before.
Yeah. Has it been something that you've seen before?
So it's very interesting because on the day that the markets fell very sharply, I received a lot of calls asking whether the 7.5% decline for the Singapore market was the steepest in history. So I actually went back to check. There have been previous incidents of further decline. Once was during the COVID-19 period, and then the other one was during the global financial crisis. So not the first time that we've seen such a sharp fall, but definitely one of the sharpest falls in the history of the Singapore market.
Okay. And how did you personally react to that situation? All the news that has happened so far?
I think given what has happened, the first reaction that many people would have is naturally this is a very sharp fall, not something that we have seen in recent years, given that the stock market has done very well. I think for me, it is part and parcel of the financial markets. There have been many episodes in my, I would say not too long, but also not too short experience looking at the financial markets. And I think this is not the sharpest decline, but I think what we always see is the reactions would be quite similar in that naturally people would start asking, should we start buying? Is it time to sell? What should we be doing? So I think while the causes leading to each of these different market corrections are different, but what is interesting to me is that actually in many different instances, the kind of reactions that we get from investors would be pretty much the same.
And it's interesting because I think theoretically we know these things to be true, right? It's happened before, it could be worse, maybe we're investing for the long term. But I think on an emotional level, it can get pretty turbulent. I think for me, I'm feeling a little bit detached in the sense that I think personally I only started investing very seriously maybe about 5 years ago. And this was probably early during the COVID days. And since then, I think more or less the market has only gone up, right? And that was also when I think I was at a point in my career where I actually had decent amount of savings to put into the market. And I think over the last week, as I've started seeing, all of these things dropping, on one hand, it doesn't hurt as much because of how much my portfolio has gained over the last few years. But at the same time, it feels a little bit unreal. And I think I'm trying to sort of stay in that space where I have to remind myself I'm investing over a 25 to 30 year period, right? And I'm only maybe 4.5 years in. But at the same time, I'm looking at all of these essentially hard-earned savings, right? Evaporate just like that. So I'm at a point now where I stopped checking. I just try not to think about it. I read the news, and I think it helps to read the news but not look at my portfolio.
Yeah.
And I'm just trying to stay kind of balanced and calm in that space right now. Yeah. What about yourself?
I had two very distinct reactions. So the reaction to the actual news of the tariffs, I had a feeling a sense of disbelief. I saw that picture of him with the styrofoam board, and I was just like, wow, this is how the world is going to go down. So I think I have this sense of disbelief that this is actually happening on a large scale and across so many different countries being affected. And you hear more of the news coming out, and some of the reasoning and the rationale behind the tariffs didn't really make sense. So there was also a sense of amusement. It did seem in a very, very black comedy way, quite funny, funny to me. We're living in a parallel reality that's not real life. So that was the initial reaction to the actual news. But then subsequently, of course, when the market reacted, right, I think I'm quite stoic nowadays when it comes to markets ups and downs, because I also, not to say have a very long career, but have had enough time in the market to have witnessed quite a number of increases and drops. So over the years, maybe I've developed a bit of a thicker skin when it comes to like reactions in the markets dropping. But I still look. I mean, unlike you, I open the trading app all the time.
Right.
So I have like 3 or 4 screens in the house, which opens up to like different charts of like certain stocks that I'm watching. And part of it is because it's to deploy additional cash in. If let's say the price is at a level that I feel like is a good price, then I can go in. And so, but it's just fascinating to watch the reaction overall. Yeah.
So I think a lot of people would react to the news with panic.
Yeah.
You seem to have a more stoic reaction to what is happening around us. So how do you actually do that?
I think for me personally is to have a very strong sense of why you're investing in the first place. Like if you don't have conviction in your investing strategy, then you're going to have a harder time managing your emotions. And so we can talk a little bit about this a little bit later, but I have a set strategy that I follow, and then more tactical sort of approaches depending on different market events. So I think having a strategy and sticking to it and being confident in your strategy is very important to be be level-headed during this kind of period.
Yeah. And I guess I also consider myself quite lucky that a lot of this money is not money that I need right now. I think if I was in let's say a financial situation where I had a lot of expenses, I think I would be feeling quite differently. So I think knowing also what the money is for and when I would actually need it really helps to give some perspective.
And I mean, kind of like jumping off the point earlier that you mentioned that this is like you've only started investing in the past 4 years or so, right?
4 or 5 years.
And I think a lot of our audience, especially the younger generation that just coming out to work, have also just started investing over the last 4 or 5 years. So they may not have felt the type of volatility that we are experiencing. I saw someone make a joke that this kind of volatility is the kind of volatility that for the crypto bros, it's like a regular Tuesday for them. So if you're just someone who is investing in the stock market in the past 4 years or so, you probably have not experienced this. And this is your first time really having that experience.
So I think for myself, having started investing in 2008, actually this is not the first crisis or significant market move that I've seen. I mean, the first was definitely when I started working back in 2008. I can still remember the first day that I started working. That was the day that Lehman Brothers actually collapsed. So when I was
the actual day.
Yes, correct.
Wow.
So when I was actually coming out from the train station and to the office, the first sight that I saw was actually people carrying carton boxes out of the office.
Oh, wow.
So that actually left a very deep impression on me around while we are actually investing for the long term, planning for the long term, it is also important to be prepared for some of these unexpected events. And I think just in the past week alone, we have seen some of this actually come up.
Something that I am wondering at the back of my mind is, how bad could this get, right? In the worst case scenario, could I actually end up losing all of my money, right? I mean, what is your perspective on this?
So in terms of how this can potentially impact the market, I would say the two most obvious implications would be inflation is likely to go up with the additional tariffs, with the kind of potential supply chain dislocation. It is very likely that prices are going up. Already we have seen the expectations around the price pressure increasing in the US. So that is something that may actually lead to the price pressure going up once again. The other point is really around slowing down of the economy as consumers actually slow down on their spending, as businesses face all of this uncertainty as to whether they want to be investing in China, in Vietnam, or in the US. I think inevitably we'll see some slowdown in spending there as well. So one story that I often share is imagine you are actually a business manager. You had spent a few years actually trying to develop this like China plus one strategy, setting up a new factory in Vietnam or some other parts of Southeast Asia, and then you wake up to realize that, oh, actually Vietnam has a tariff that's almost as high as what you face in China. I think the kind of real-world decision that you then have to make as to then what is the next step that you take, whether you continue exporting from this factory, whether you want to set up a new factory somewhere else. I think those are the real questions that these business leaders then have to make. And I think in this world of uncertainty that we are in right now, most of them will likely pause before deciding what is the next step that they want to be taking.
You know, it's interesting you mentioned about like the business decisions. I don't think I've ever seen that many people interested in economics before, and like people asking questions like, what is the tariff and what's the difference between a tariff and a trade deficit? The number of people who ask me and the number of people talking about it on TikTok about like the difference between the reciprocal tariff and a trade deficit has kind of skyrocketed, and I think it's kind of a good thing, right? Because now you realize actually people are actually taking an interest in something that before this most people didn't even care about. And people are even getting interested in like how supply chain works, right? Like why things are manufactured in certain countries, and you know it's just not as easy as like, or you know the whole reason they want to implement this tariff is to reshore manufacturing in the US, but there are all these other obstacles that can cause issues there. And I think, you know, while generally people who might be investing in the market or will be doing research on companies might have some understanding of this, it's also interesting to see that people who are not really that familiar with these sort of topics now starting to get an understanding, grasp of what it is.
So for the benefit of all our viewers, I think we should then explain what tariffs are and what trade deficit are, okay? Maybe I'll start with the tariff part because that would be the easier one. So a tariff is a tax on imports. So in the same way that we pay income tax, we pay goods and services tax, it would actually lead to a higher price for these imports because the country or the government would tax on these imports that are going into the country, whether is it US or China in this case.
Just quick question, who pays the tax for the imports? Is the country that you're importing it from or the company that is importing the product?
Okay, so the direct payer of the tax would usually be the company that is bringing this good into the country. So for example, if I am manufacturing iPhones, Apple would then have to pay this tax to bring in the phones that they're manufacturing in China to sell in the US. But the important question is whether they will then raise the prices of what they are selling in the US. So in the end, these higher prices might then be borne by the consumer.
Yeah, so I think a good example was, I think a headline that was just published this morning about how Apple was flying in like 1.5 million iPhones to get around some of these tariffs. And if they had not been able to do that, I think like a $2,000 iPhone 16 Pro would have cost $3,000 for the consumer because that cost would have been passed on to the consumer instead.
So I think because of that, the concern is as the prices go up, consumers will cut back on their spending, whether is it towards a new iPhone or a pair of shoes, a laptop, and that would inevitably lead to lower demand for some of these services, and companies will then suffer when they are no longer able to sell some of these goods and services.
And because the prices of these things are passed on to the consumer, that's also what might cause inflation as well, right? Right. Okay, so that's the tariff. Now, people are talking about the trade deficit as well. So could you explain what that is and how is it relating to the tariff in this case?
Okay, so I think this is important for us in Singapore because we are very dependent on trade. And I think generally what countries want to be doing is to be able to export more than they import. This means that the country is selling more to other countries than they are buying from other countries. The reason for that is then the company is able to build up on their reserves. They are not then dependent on other countries to be able to sustain their economy. So in a very simple way, that is why countries would want to be in a surplus condition rather than in a deficit condition. But I think it's also important here to then note what is then seen to be a surplus from a trade perspective, and whether we think about other things that can be exported, including like your services. When tourists come into Singapore, they might actually be spending their money here. So that is one element that might not be considered if I'm just thinking from a very simple definition of a trade deficit, which is just measured in terms of how much goods are being exported versus being imported.
Okay, so having said all of that, right, we talked about the market reaction, we talked about like why the market is reacting that way, what is a tariff, what is a trade deficit.
Yeah.
I think what I guess we want to kind of go into is like what do you think that investors and just your regular everyday people who are trying to manage their personal finances, are there anything positive? Is there any bright spots for them? Or is it just all bad news and doom and gloom?
So one of the most commonly asked questions is, should I buy? Should I be selling? What should I be doing in this market? I think one of the points you brought up earlier was definitely very relevant in terms of understanding why you are investing. I think once you understand why you're investing, this question around whether you should be buying or selling becomes a lot easier to answer. Because, for example, if you're investing for the long term, then that provides a different kind of backdrop versus if I need the cash for buying my HDB in 2 years' time, or whether I might have some emergency use of this cash. I think in terms of one other principle that I would generally share is the need to diversify. Because if I am just singularly looking at one asset class, whether is it Apple stock, Tesla stock, or even the S&P 500, then I think that effectively leaves us exposed to some of these developments. So while the S&P 500 is diversified across 500 different companies, effectively you are still exposed towards the US market. And what we have seen over the past 1 month is that the US market has definitely been a lot more volatile versus some of the other markets or other asset classes. So one asset class that many people may not have at the back of their mind is gold. It has been actually doing well against the backdrop of higher geopolitical tensions as well as inflation. So for those who have seen the sharp falls in the US market and then comparing it to the performance of gold, you'll be able to see how these two different asset classes have actually had different performances over the last few months.
Do you think gold is not popular? I thought gold was quite popular with the older generation.
Okay, so at Beansprout, we actually share about different asset classes and we can see the level of interest amongst our community. I would say for a lot of Singapore-based investors, they look at income stocks, they look at Singapore banks, Singapore REITs. For a lot of the younger investors, they look at US stocks, particularly the Magnificent Seven. Gold, I would say there are questions around it, but compared to what we see for, say, the Singapore banks or the S&P 500, it seems like there are less people asking questions about this asset class.
Do you find yourself getting a lot of questions about, like, what should I buy right now? I mean, how do you find yourself responding to questions like these?
I think it goes back to the principle that we have often shared, which is first and foremost, know what you're buying. In that, the question around what you should be buying or whether you should be buying now, a lot depends on what you have in your portfolio at this point in time. So for example, if my portfolio is already entirely in NVIDIA or Tesla or the S&P 500, then the question is whether there might be a need to diversify our holdings to be able to build a more resilient portfolio. At the same time, for those of us that may have a significant exposure towards just equities, the question is whether we can think about diversifying through other asset classes like bonds or gold. So I think the way I would think about it is how we can make use of this market volatility to actually reposition our portfolios to be closer to what is aligned with our investment objectives as well as risk appetite.
Right.
Yeah.
Okay. So we've talked a little bit about investors, right? I'm wondering for regular consumers, I think one of the terms that I've also been hearing quite a bit more of is recession. right? And people saying that, we're headed for a recession. Some people say that we're already there.
Yeah.
And I'm wondering if it's useful for us to, first and foremost clarify what exactly counts as a recession. And for regular consumers, I mean, what does that really mean for our day-to-day lives? Yeah.
From a technical perspective, a recession is 2 consecutive quarters of negative economic growth. So when we see people come out with expectations that, there's a higher likelihood of a recession, that is what they actually mean, where we might actually see periods where rather than having economic growth, we're actually seeing periods of economic decline. Okay, and I think in the past, when we have seen these periods of economic decline, they are often associated with potential job losses as companies cut back on their spending. I think that's probably what a lot of consumers are probably worried about.
Yeah, I mean, just hearing the word alone, I think the other day I was, I was having dinner and I was just feeling a bit tired and thinking, do I want to take a cab home? And immediately, I thought actually maybe I shouldn't, right? So I think even in these small ways, I find myself sort of like tightening my spending, and just generally trying to see, how I can be a little bit more prudent and things like that. Yeah.
So actually, you're not alone in thinking that way. There was one economic data that came out in the US, where if they were to look at the economic expectations of consumers in the US, it's actually now as weak as what it was during the COVID-19 period. And I think that is what is driving all of this recession concerns, where while the current indicators may still reflect fairly healthy growth, should every consumer react in the same way as you do, then that might actually then push the economy into a slowdown.
Well,
Yeah.
I think for me, so I think I have similar sort of sentiment as you. My issue is not so much that there's a recession coming, it's the uncertainty of a possible recession. Because then you don't really know how to react, whether you should take risks and spend money. Like if you want to go on a holiday, for example, now you're like rethinking whether you want to go on a holiday because there's a potential recession coming. And I think because of the uncertainty, that's what's holding me back from actually doing or spending on the things that I would want to usually spend on to help improve my quality of life. So I think I'm more worried about the uncertainty more so than the actual recession. Like if it actually came, I don't think I'll be like, okay, fine, it's here, and then I know what to do. But I think it's just more of like, okay, I don't really know how to react because we don't know what the situation is going to be.
Right.
And every day, I think this is the struggle that most people are facing. At least in my friend group, right? You are seeing all this uncertainty in the market, and that also plays out on a daily basis in their lives as well. The rule of thumb I always have for myself and just generally, like when people ask me this question, is to have like emergency fund. It's the most unsexy thing when it comes to your personal finance, but I think it's very, very important to have it. Whether there is a recession or no recession, you should have emergency funds because job loss can happen at any time. And so having that buffer to then fall back on gives you that peace of mind to ensure that, if you were to lose your job, that you have this buffer and you can then use that period to comfortably look for another job.
I think one thing that I've been hearing a lot about also is, I think, kind of a conversation around like secondary income streams. And I think especially more and more for some of my peers who are going through job transitions, things like that, people looking at what we now call kind of like a portfolio career, right? And seeing how even if, let's say, you lose one income stream, you have another that's supporting you, right? Whether these are side hustles, jobs and things like that.
So to me, another source of secondary income stream is actually from your investments. I think that is why we often share ways that you can generate passive income, dividend stocks, T-bills, Singapore savings bonds. These are all different income instruments that we can consider as a way to also build our secondary income streams away from being able to do that through our jobs. I think this week you wrote something about the money diaries where this person was trying to get a 6,000 passive income stream while traveling to 50 countries.
So I think this week we'll be publishing a piece on a gentleman named Ken, and he runs his own business, freelances as a trainer, and he has, I think currently he is probably around 2 to 3K in terms of passive income. I think he's aiming to reach 4. And for him, it is all about fueling his passion for travel, right? And I think it's quite interesting to see how over time he has managed to kind of design his portfolio to match really what he wants his life to look like. It sounds like a lot of work, but I think what it shows is that it is possible if you're willing to take the time to learn about different asset classes and to structure your portfolio in a way that supports your aspirations. Yeah.
They don't really take the time to do. So I think a lot of people think of investing backwards. They always think about what should I buy, but they don't think about actually what am I trying to achieve first. So I think rather than thinking about, okay, what should I buy in the market, the strategy that I use is goals-based investing. And depending on the goals that you have, then allocating your income and your investments to those particular goals. And if you don't have any goals, then it's harder for you to then not react. So this is the strategy that basically what I mentioned earlier that I do, which is that I have certain set goals, so short, medium, long-term goals, and each goal will have allocation to an asset class that fits that time horizon. So like if it's short term, that means it has to be money that I'm going to be using very quickly, right? Like in maybe the next 1 year or so. Then I can't put it in, I don't know, Palantir or use that money to buy options, because then it's very high risk, right? And there's a potential of losing that money in that 1 year period. So of course, then going for more safer instruments, looking at maybe like T-bills or like high yield savings account. And then medium to long term, then looking at different asset classes. Maybe could it be bonds? Could it be like gold, for instance? As well as still staying invested in the market, because there's time for that to ride out that volatility and stay invested and compound over time. So do you think that that's an approach that people can take?
Definitely understanding what your goals are would be the starting point. Because if you do not know why you are investing, it then becomes very hard to make the decision around whether you should be buying or selling, because you do not really know what you're investing for. So I think that is always what we would start with. Thereafter, I think segregating them into different portfolios would be helpful, because then we can better think about what each of these different asset classes play within that portfolio and whether that can help you to achieve your objectives.
Okay.
Yeah. And I guess like the final thing that we were just talking about just now, right? When it comes to investing, we often think of it in terms of financial investments. But I think during times of uncertainty like this, that can be honestly quite stressful, quite emotionally turbulent. I do think it's important to remember that there are other areas of our lives also that, are equally worth investing in, right? So these are things like, should we be spending more time with friends and family? Should we be investing in our health, right? And even things like paying more attention to maybe hobbies that we have dropped, right? And that we haven't been pursuing for a long time. I think all of these things come together to form, I guess, a more holistic life. And it's really not, it is about the money, but also not just about the money.
I mentioned earlier that like we have these 4 screens in the house, right? So we've been kind of glued to the screens quite a lot the last few days. But I think just yesterday we kind of had this like brain rot fatigue looking at the market, and basically I had to tell myself, you know what, just turn off all the screens and just go outside and touch grass. Because sometimes it's just not helpful to just be looking at it and like every single update, then you're seeing the ticker move, and then you're just playing with your emotions without even realizing it, and it's draining you. So it might make more sense to like invest time doing other things instead.
So maybe to end off so that our audience can go out to be touching the grass, what are some final words that you'd like to share with those who have joined us today?
I think for me personally, it's really about, I think I really resonated with what you said about like short, medium and long-term goals. I think this week for me has really been about coming back to that, right? And reminding myself, like, why am I doing this and what the money is for? And honestly, I haven't been doing much of that this year. I think this year, for me, both on a career and a personal front, a lot has been happening. So I haven't really been thinking about these things. So I'm really spending this time now to sit down, take stock of where my portfolio is at, what am I designing it for, and to remember what really matters. So really, touching grass, going out, and also seeing like what is my immediate reality versus what's happening out there, and finding the balance between that. So that really has been the biggest takeaway for me.
Okay.
Yeah.
Cool.
Yeah.
For me, I mean, to remain stoic in a very turbulent market, you have to let go of the things that you cannot control. So whatever Trump does, whatever decisions that he makes, that we have to remind ourselves that these are things that we cannot control. And focus your efforts on things that you can control. So be that reevaluating your portfolio, taking time to do some research, going out and spending time with your family, or upskilling, or finding a secondary source of income. Those are things that are within your control. And rather than spend time trying to figure out what's going to happen, I think it's much better use of energy to focus on things that you can make a difference in your life. So that's my key takeaway from this past week.
Yeah, I think just to quickly add to that, I think final thing for me is also just, it's really been a lesson in like managing expectations. Like the other day I just caught myself thinking like, what was I expecting, right? Was the market just going to go up indefinitely? And we know historically that's not how it works. So I find I'm really kind of taking this as one of my very formative lessons as an investor. And yeah, I'm just trying to learn as much as I can from this experience. Yeah. What about yourself, Gerald?
So I think the point around working on what you can control is definitely very important. And to me, what I can control is whether I take the time to understand more about what I'm investing in. I take the time to think about why I'm investing. If there's any key takeaway from today's sharing, I think those are the two key things that we can just spend 30 minutes or 1 hour after watching this to evaluate ourselves, because while there might be a lot of uncertainty out there, what is most important is how we can actually make use of this opportunity to gain better understanding of ourselves, gain better understanding of our financial plans, gain better understanding of why we are investing. I think that can become something that's very valuable in itself. And I think whatever losses or financial pain that might come through in the short term, we can just take that as a kind of like tuition fee while we are improving ourselves in other ways.
Cool.
Yeah, I think that's kind of a nice place to end this week's podcast.
Yeah, so I guess this is our first episode, and if you like to hear more from us, if you have any topics that you would like us to cover, I think feel free to send us some feedback, share with us what are some areas that if you have any questions that you want us to address on the podcast, then we will be happy to add that in.
And I think something nice that we have is also like kind of a nice network of access to different fund managers, CEOs of listed companies and things like that. So if there's anyone that our listeners would like us to interview on this show, I think we love to do more of that as well.